The Krieger Files.
Yeah, plus twice if you want to send a message to Congress. Fred Dashevsky joins us. I promised you Fred would be here. And here's the beauty about it. This guy is so melded into economics as part of his education, growing up and everything he's done in the gold and silver coin industry. He's a member of the American Numismatic Association. He is also one of these, them there fancy graders. He's a grader of all sorts. I got myself one of these silver dollars right here. That's MS 65.
Look how beautiful that is.
I love it, man. Mint State 65, baby. Can you do better than that?
In theory, you can go up to 66s and 7s and 8s, but they become pretty expensive if you can find them.
I bet they do, but hey, I got this when I bought these. Okay. All right, so you see, Fred's got all sorts of deals at uscoincapital.com. I talked to somebody in Florida yesterday that's bought from you before, Fred, and she wants to come back and buy again. She says she tries whenever she can, and she encourages people to do the same. And, the beauty about it is that we've got some, I don't know if it's earth-shattering news, but what happened to gold over this last week?
So, for the first time, I saw the futures price last week, Thursday and Friday, go over 3,100. Now, that's futures, so it tends to be ahead of the market. And a lot of times over the weekend, depending upon what happens, economic news, the market can pull back. I wasn't necessarily expecting to see it, but here we are today, $3,125 on the spot price of gold. And that puts us up about, I'm thinking 20% since January 1, where we started at around 2,600. And I think on your show, I commented that, if things went the way I expected, we might see $3,200 gold before the end of the year. And here we are now. Okay, and it's 31 and a quarter at the end of the first quarter of the year. So this is clearly in response to a massive accumulation, and it is going on worldwide. I mean, all the central banks are aggressively adding gold, and the price continues to go up. And of course, the trade wars, it creates a level of uncertainty, I guess is the best way to put it. And in those times of uncertainty, gold has been around for thousands of years as a stabilizing variable, and people are attracted to it for that particular reason, which I think is appropriate. I also think the long-term outlook continues to be quite strong moving forward from here.
I'm just wondering, though, there are headlines floating around out there about swapping U.S. gold reserves for Bitcoin. I'm like, this doesn't make any sense because gold, I mean, you were just hold that $5 gold piece. You got to see this, folks.
This is in the extraordinary range. Okay, so what you're looking at here, I don't know if it's coming up on camera.
Oh, I can see it.
This is the very first United States gold coin minted in American history. By 1792, when we got around to creating the first U.S. monetary system, it was done with gold and silver. But by the time they got around to minting the first $5 gold coin, it was a couple of years later. This is one of 8,000 minted in 1795. Remains one of less than a couple of dozen examples of this date ever seen. This is probably amongst the second or third finest in quality that's ever been found. And if you look at we call the reverse, it has what I lovingly call the skinny chicken, because the artist who created it, this was a hand-drawn design of an American eagle. 1 year later, we would get the expanded thickness in the eagle breast that would become known as the heraldic eagle, which is currently seen a lot as the presidential seal, the symbol. So this was the only skinny chicken, 1795, and this is just one beautiful, bright. Can you imagine this thing has survived? It's never been polished, never been cleaned. This is its original condition since 1795.
Now, what is the grade on it? Is that an AU grade or what is it?
It's an AU55. Yep, so it's almost uncirculated, just has a little hint of wear. And in this kind of condition, you're looking at a $65,000 coin.
Oh, my. Folks, I'm telling you what, if you're not watching us live on the KriegerFiles.com, we do have a video link where Fred's holding that up and you can see it. If you miss it, you can go to Rumble later on in the day. I'll have it posted up there with this interview, and you can look at that in hot little hand. Are you selling that, or is that's one of your latest acquisitions?
No, if somebody makes me the offer, I'll probably sell it. A lot of times I have a hard time as a long-time investor in gold and silver coins. I'm like one of those guys who buys great guitars, and you play them, you want to use them, and you don't want to sell them, and you end up collecting them. So I don't know. I'm thinking about it. But anyway, it's
so
available.
How many guitars do you have, just out of curiosity?
Well, I'm not bad there. I only have 4 guitars. I have 2 acoustics and 2 electrics, so I'm not crazy when it comes to that.
See, here's the thing. I remember when we were on stage in Terre Haute, Indiana, back in the 70s, jamming with REO Speedwagon, and Gary Richrath had 67 guitars.
He just recently passed, right?
It was a few years back, but he had 1 guitar left when he died, and where'd the other 66 go? Up his nose.
Oh, that's a shame.
Gary was, man, I'm telling you what, I'll never forget the day he came into my hotel room, pulled out a bag of dope, started lighting it up, and I'm like, what are you doing, dude? Seriously, you're in Terre Haute, Indiana. This is where the federal penitentiary is. Why are you doing this in my hotel room?
I saw them in Savannah about a year ago, the remaining members. They were fantastic. They really were.
I could tell you some stories about my time in the rock circuit, but I actually was, I knew these guys. So anyway, it's one of those backstories that nobody wants to talk about. He ended up throwing a whole bag of pot all over my carpet in my room, and back then it was shag carpet, so we were all like freaking out, going around picking up all the pot. It was awful. Anyway,
the 70s.
I know, the 70s. You got to love it. But the thing is if you would have bought gold coins, to be financially right now.
Well, in the 70s, you were probably still looking at $300 gold. So, depending on what year, it could have been as low as $35 an ounce, 72, 73. By 77, it was about $100 an ounce for gold. Even as late as 2019, those standard $20 gold coins, which today are $3,600 coins, we're running $500 or $400 or so, even in top quality mint condition. So, the increase in their value has been consistent decade after decade. And of course, it couples itself with the advancement of the number of paper dollars that we've created since then, too. And, back in those days, we had government debt that was still in the hundreds of millions. We haven't even hit $1 billion yet in government debt. And here we are today, 36 trillion, and the government is a couple of months again from running out of money. So we're about to have another one of these debt limit, quote unquote, crises, which will come and go. As the government folds like the proverbial cheap tent and raises the debt limit one more time back into the breach.
Wow. And see, here's the thing. We're looking at not only the price of gold, and we were on the gold standard, but that was eliminated. And that took, any value at all out of the fiat currency we now have in circulation. And so, do you ever see the gold standard coming back? Is there anybody pushing that right now that you know of?
Well, a full gold standard on a national basis, I think, is mechanically impossible. I just don't think the government could withstand that lockdown of the constraint of not being able to print the amount of money they need if they were forced to maintain a standard. There are interesting things, though. We had talked about the Wyoming law that passed about a month ago, where the state has now issued an actual law. It has passed. It's been signed by the governor. And it requires the state to start holding physical gold and silver as a portion of what they hold in their government coffers. Plus, they're looking into a process by which the people within the state could actually transact commerce with gold and silver legally. So they're trying to figure out a way to do that. Now, if we can do this on a state-by-state basis, that would be fantastic. I mean, to give people an opportunity to deal with gold and silver instead of fiat money, I love the idea of having that alternative. I don't know how far this will go. I mean, a state like Wyoming, very conservative. Obviously, it has the smallest population by state versus the size of the state itself. So, it's maybe an experimental way of looking at this, but they did get the law passed. And, hey, if you can do it in one state, you can do it in the other 49.
Well, but speaking of Wyoming, Senator Lummis from Wyoming is suggesting a Bitcoin reserve, which might help financial innovation and promote economic security. She doesn't provide any details. We're supposed to take that on faith. Politicians, of course, prefer fiat money, and expanded government control. And the only way to do that, what you're saying is true, and they go out there and they put they put the gold standard back in, like you say, is mechanically impossible because we've got this debt. They don't have enough gold to back that up. So I understand that. But now, as far as using gold reserves to possibly back CBDC, do you ever see that happening?
Well, again, there's a possibility there that we could create a system where we do have something tied to the price of gold. Anything that we can do to do that, again, the most important thing to understand about it is what it does. And it's so functionally important because it constrains the amount of money that you can simply print. And this takes away the biggest option that is currently available to governments, which is, they know if they deficit spend, they have a backstop. They have a central bank within the United States that will create whatever amount of money they are short on. So, we can hope that then the government won't default on things like Social Security or any of the debt instruments already floating out there. But these obligations are growing and growing, and they're so huge, way beyond the 36 trillion in just the bonded debt. There's so much more out there the government owes and will owe in the next few years. It doesn't have the capital for. So if we were to eliminate this possibility of just printing your way out of every problem, well, the great news there is that government would have to learn how to control its spending. Now, I don't know how it would address the existing debt. I don't know how they would backtrack that because they have to pay that debt off. This is money spent. It's owed to current holders of bonds and treasuries across the world. And we need people to buy more of this. The continual need for debt selling is staggering. The numbers are just mind-boggling. I would love to see some sort of standard, because wouldn't it be great if people could earn $1 and feel comfortable knowing that if I don't spend it today and really do save it for 10 or 15 or 20 years, that it's still actually going to buy the same amount it did when I worked to earn it. Otherwise we have that deterioration of dollars over time. And that graph is really ugly. When you look at a dollar's value over time and how much it's losing, the rate at which it's losing is accelerating and accelerating. Like the car is getting faster and faster and faster, but very little time is moving as we lose more value. So the public is facing a very challenging problem, and we can see what's happening as around the world, people look at it and say, well, I have a solution. I'll just put my money into physical gold and silver. So I get the idea of a crypto exchange or a crypto bank, but I've never been a huge fan of it, only because when you have to define the value of something based upon the premise that other people will see it as having value, and other than that, it really has no other value, that to me is a challenge. And I may be old and stubborn, but I'd rather have, my 60 grand or $65,000 sitting in this physical form that I have in my possession. I know it cannot be recreated. Nobody can go back to 1795 and make any more of these things. Whatever's floating around there, out there today, that's it. So,
that's enough to buy a house. You could literally trade somebody for a small house or a cottage on acreage for that.
On the smaller scale, we have silver. Now silver's running around now $34 an ounce. I have a couple of specials up on the website. If you haven't had a chance to see them yet, they're under the specials under the website, and we've got a couple of great inexpensive packages, both under two of them under $5,000. They combine together for about $8,000. It's some silver dollars and some Walking Liberty half dollars that we were able to acquire at a really good rate. And I think this is a great way for those people that are maybe not looking to buy a single coin for $65,000, but do want to invest a little bit in physical silver. You can do that affordably with a couple of the specials that are up on the website.
Interesting. That's uscoincapital.com. And if you have questions, it's 1-800-878-2646. The number to call rolls right off of my tongue. See, it's in my head. I can't get rid of that number, Fred. So here's the deal. The Fed, we are told, is holding $2 trillion worth of mortgage-backed securities. Is this dangerous for the American economy? Them holding that much?
I don't like when any one entity has to hold that quantity. And, for the Fed to do it means that they are, again, buyers of last resort. That means that could not have been dealt with in any other fashion except to end up on the balance sheet of the Fed. The Fed has been accumulating mortgage-backed debt since 2007 and 2008. And, if you want to look at it objectively, the way I see it is they have not even been able to address what they had to buy back in 2008. That is still carrying on the Fed's balance sheet, which you can pull up on the Federal Reserve's data.
Yeah.
If you go to the St. Louis Fed and look it up, it's actually called FRED, Federal Reserve Economic Data. And if you look at their balance sheet, you will see this massive quantity of mortgage-backed securities and other instruments that they bought way back in 2008. They have not yet been able to either redeem or get rid of and sell off in the secondary market. If the Fed is buying more mortgage-backed securities from the banks, this is not a safe play for people. It means that we have a really difficult environment that we can't sell to the general public. And again, by default, we're going to the big central bank and saying, well, bail us out and help us take some of this stuff off of our balance sheets. So the Fed ends up with these monster securities, which eventually they have to try to get rid of, which means they have to sell it to somebody. And that means it gets discounted or it sits on their balance sheets indefinitely and weighs down their ability to buy more debt, which again, they do an awful lot of current debt as well. And I don't like the idea that the central bank has to become the owner of last resort for mortgages. You know, you and I remember the days where when my parents got their mortgage, they literally went to the local bank.
Yeah.
And the local bank held that mortgage for 40 years or 30 years, 15 years. That one bank was responsible for it. Therefore, they were pretty particular about to whom they would loan that money. And they expected those repayments. And they carried that obligation on their balance sheet. And if they couldn't,
that's what we call that's a portfolio loan is what we call it, because the note you signed and the mortgage you signed went into their vault and it stayed there. And they knew who you were. The Know Thy Customer was really big back then, and they knew you were a safe bet. Otherwise, they wouldn't have made you the loan in the first place. And it was an actual legitimate loan too, right?
It was absolutely legitimate because they really did make sure that you were able to make those payments. Now, of course, over the years when we got sloppy and started making loans to people that didn't have the ability because we were trying to get home ownership amongst a broader number of people, while the objective was sort of nice, the result of it was horrible. And it really has had a negative impact on the real estate market. You know, last year was a pretty tough year for the real estate industry. The home sales slowed dramatically because everybody was kind of freaking out about the higher rates on mortgages. And even though they were only, what did they peak at, 8.5% last year, and they've come down a little since then, it still was enough to slow the market down because people sat on the sidelines waiting. And now we're at an environment where we're beginning to see the pace of mortgage sales pick up again. So for those that are in that area, I think your year is going to be better than last year. And I think that's a good, positive thing for the overall economy. But I find it difficult when I look at how it used to work compared to what it does now. If you were a bank and I came to you for a loan and you checked me out and said, okay, you're good enough to do it, you held that obligation until I paid it off. Nowadays, what you'll do is you'll sell that note to some third party so that you don't have the obligation anymore. You get paid in full. So you don't care whether or not I ever make a payment because you have zero risk. And that changes the nature of the game. So if we allow the banks to sell off the mortgages to other parties, we're taking away the whole idea of the bank as an intermediary determining whether or not you should have had that loan in the first place. And that creates a very dangerous market. And this is where I'm sure a lot of the defaults that you deal with when you see these loans going bad, this is where it stems from.
Exactly.
Well, never gotten a loan in the first place.
Bingo. And see, the Mortgage Bankers Association has just reported that mortgage purchase applications were up 7% last week from the same time a year ago. And the thing, one of the home buyers told the Wall Street Journal, you can't pause your life for what the rates are going to do. We have to move on. I'm like, what, at 6.5%? Really? The Fed is choking the economy, is it not?
Well, it is. And the Fed is facing an interesting problem. The dynamic that the Fed has to address is the dual-edged sword, okay? It is very sharp on both ends. One is you got to keep interest rates low enough to keep an economy moving forward. You can't create an environment where it's too expensive because just like last year, even a point or so could change the nature of how many people are willing to or could afford a mortgage. The second thing the Fed has to do is not be too low to create an overstimulated economy and have false environments that lead them to then have to raise rates to soak up all this liquidity that they've created. It is a really challenging balance that the Fed faces, on top of which, of course, now If you just wanted to throw a monkey wrench into the works, well, let's throw trade wars up there. And, every day, let's change the nature of who we deal with and what we're doing and how much we're paying. I have yet to have anybody really clearly explain to me how these things are not inflationary. I heard this argument early, but every one of those guys seems to have gotten very quiet over the past few months, as I think the reality is becoming quite clear. The importer is going to pay those premium taxes on those imports. Those costs will get passed on to a consumer. I'm sorry, there is simply no way they're going to absorb 25% rate increases and not pass that along somewhere. So we are all going to pay for this trade war nonsense that's going on. And maybe in the long term, it'll be beneficial, but I don't know. I don't see it.
See, here's the excuse. And I've said this before, Fred. Trump's doing this to get these people to move their facilities back into the United States and create manufacturing
Absolutely.
jobs. I figured you'd agree with me on that. I mean, there's nothing, but I do agree, because in the interim, when all these vehicles are coming into the country and they're getting these tariffs slapped on them, nobody's going to buy these cars. They're going to be too damned expensive.
Well, if we're going to take away the elimination of the option of the cheaper foreign car, well, then we'll be forced to do that by the American-built car, which, again, that may be good for the industry. So if you're trying to protect the auto industry, the steel workers, by raising tariffs on steel and raising tariffs on automobiles coming from outside the U.S., you may have some success in shifting demand toward American-built cars. But we will pay more for those American-built cars, as we always have, because it's a manufacturing issue. We know it costs more to build stuff here than it does, in Mexico or in China, because they don't have the same regulations and rules that we have. So we have this option. People who can't afford a good, high-quality American luxury car may be able to afford something coming out of Korea or something coming out of China. But if we take away that option because we're raising tariffs and therefore those costs are passed along, well, okay, so we'll start buying more American cars, but we'll also be paying more for them. So we create one problem, we solution one problem. Again, there's an interesting balance there. How it all fares out in the end to the average consumer, I'm still coming down on the side that in the end, this is going to be highly inflationary. It may help our economy in the long term. Nothing better than having manufacturing done in your own domestic country, but it's going to come at a cost.
Oh, well, of course it will. Now, of course, today is the final trading day of Q1, quarter number 1. 2025 has not gone according to plan for Wall Street. The S&P 500, it's got its 5th weekly loss in 6 weeks. The tech-focused NASDAQ is officially in correction territory, down more than 10% from its recent peak. I mean, the thing is this is a time to start really thinking about investing in gold and silver right now and getting out of the stock market. You see it going lower?
I do. Well, the volatility is really interesting to me. So that VIX, the volatility index, peaked at like 29 about a month ago, and we were seeing 800,000 point daily swings in the stock market. It dropped down to about 18 or 19 last week, and we got down to maybe 50 to 100 point swings in the market. Now it's back up 22, 23. And again, we're seeing the volatility again, and the S&P has pretty much lost everything it had gained, and we're back now underneath where we started. So I see this as problematic going forward because I think the volatility is now inherent in the market. So it's not like we're heading up slowly or heading down slowly. We're getting up and down swings almost daily. And of course, if tomorrow the news comes out of a new tariff on a new product, that industry will then feel the impact, and all the stocks related to it will feel the impact. And I think as long as this uncertainty prevails, you're also creating a problem where, if you are an investor, you may be scratching your head thinking, is this a time to get into the market? Will it go lower? I think we're going to struggle moving forward from here. I hope to see that the market at least recovers to where it was at the beginning of the year, but this volatility is going to be the real key going forward. So it's all going to be about where the dollar resides around the world, where interest rates reside around the world, and how the upsetting uncertainty of tariffs, filter their way through the economy. I would expect volatility, if nothing else.
Yeah, it's a good time to get out of the market. I did a while back, and people, they're like, Krieger, you shouldn't have done that. You should have stayed in the money. Yeah, well, we'd be suffering. As much as we are right now, we have a lot of people that are real estate rich and cash poor as a result. And now we've got a story out that the baby boomers and everybody that's passing away is expected to leave about $84 trillion to their descendants in the coming 2 decades, according to Cerulli Associates. I don't know if you heard that news or not, Fred, but that's kind of scary because you don't know what these people are not disciplined with their money, I don't think. Your parting comment, we got about 20 seconds left.
This is the largest rollover of money in American history. This is monstrously huge. And as that money does filter into that next generation, they're going to face some pretty challenging problems. All I can say is after 40 years of being in the gold and silver coin business, if I've learned anything from listening to everybody and watching, diversification is very helpful. Just make sure you have more than one kind of asset. And one of those kinds of assets should be a physical, tangible thing you can hold in your hands.
We appreciate that, Fred Dashevsky. Thank you so much. USCoinCapital.com. We'll see you tomorrow. Stay with us. In the meantime, God bless you. God bless the United States and the United States of America.